Welcome back. If you're new to my channel, then get ready to be empowered with knowledge that's going to help you build generational wealth. We discuss all things money. It is a one-stop shop, and right now we are in the beginning discussions of the home buying process. In our last video, we weighed the pros and cons of whether it's better to rent or buy, and in this video, we are going to break down the checklist to determine whether you are ready to make that investment. Are you ready to purchase a home? Why didn't I ever learn about credit? School didn't teach us the important things, like how to file taxes. Personal endeavors to improve our financial outlook, I read a lot, and in one of the recent books that I read by Dave Ramsey, if you don't know who he is, look him up. I'm a huge fan. But after reading his book, it really made me question, were we ready to buy a home? Did we jump the gun? Were there some things that we should have done beforehand? And if I'm honest with myself, I would definitely do a few things differently. So to eliminate that guesswork for you, I have come up with this small checklist. And the first question is, are you out of debt? No, Mia, not this again. Yes, this again. Look, if you're not paying cash for your home, then in order to be approved for a home loan, they're going to look into your credit, and they're going to get into every nook and cranny of your credit score, your DTI, your mix of credit, how heavily you rely on credit. Do you need it to live, or is it a healthy mix? They're going to really dive into it in order to approve you for this home loan. So how does getting you out of debt help? Well, let me tell you, getting out of debt is only going to improve your credit score. Don't let anyone tell you anything differently. Paying off your debt will increase your credit score. I saw some of the highest point jumps when I really started getting serious about getting out of debt. When we eliminated credit card debt from our portfolio, man, we were basically looking at almost perfect credit scores. So if you want your home loan process to be smooth, go ahead and start working on getting out of debt. It's only going to help your credit score. What else it helps is your DTI. Your DTI is your debt to income ratio. Basically, what the loan officer is going to do is take a tally of your monthly debt expenses. They're going to take the minimum monthly amounts that are reported to the credit bureaus, your credit card accounts, your personal loans, your student loans, your car payments, anything, any debt payments that you have per month. They're going to tally that up, and they're going to take it as a percentage of your income. If you are at about 36% or lower, then you are typically in the clear. The standard rate is 36%. Now, mind you, that tally also includes what they are calculating to be your mortgage, okay? They're including that as in your debt to income ratio. What else they include are child care expenses. If your child is in a private school or you have to pay for daycare, they include that. If you're paying for child care, then that means you're going to work. And if you don't make your child care payment, then that means you're not going to work unless you are not getting paid and you can't pay your mortgage, and that's a problem, okay? I bet that if many of you were to go do an analysis of your debt to income ratio right now, if you were to go take a tally of the minimum monthly debt expenses that are reported to your credit bureaus in relation to your income, that debt to income ratio would be higher than the average that the loan officer is looking for. If that's the case, then that's a clear indicator that you need to start working on paying off your debt, okay? Thank me later. They don't want you to be facing any type of hardship. They want you to be able to easily make your mortgage payment. They don't want to give you money that you're not going to be able to pay back. It's a loss for them. It's a business decision, and it makes sense. So, are you out of debt? Increase your credit score if you're not by paying off your debt. Decrease your DTI. If your DTI is high, that means you've got too much debt. That means you have a really high debt to income ratio, and loan officers, the underwriter, they're not going to be very eager to approve you for a home loan. Well, Mia, what if I pay off all of my credit? Then what happens to my credit score? It goes up. You trust me. You don't have to worry about not having a credit score, okay? It takes 6 months of not using credit, not applying for credit, not swiping a credit card. It takes 6 months of having no credit activity in order to completely wipe out your credit score, okay? So even if you pay off your debt today, you've got 6 months before credit bureaus start to wonder if you're still alive. So don't worry that, oh, if I pay off all of my debt, then I'm no longer gonna have a credit score. No, you're gonna have a great credit score, and you've now got 6 months to go find a home, find your perfect home, and be approved. In addition to your credit score and your debt to income ratio, they also look into your mix of credit. Is it all credit cards? Is it a car payment? What type of credit do you have, and when's the last time you applied for credit? You do not want to apply for a lot of credit, or really, when you are buying a home, you don't want to have to be looking for credit at all, because they are really looking into your credit history, your credit portfolio. They are really deep diving into it, so you don't want to give them any reason to disapprove you. So do not need credit when you are going into the home loan approval process, because if you need debt, then they're going to start to wonder why you need debt and why are you trying to buy a home. The next thing on the checklist is your emergency fund. I highly recommend that you have a fully funded emergency fund before you go to buy a home. Why? Because there are a lot of large upfront costs to buying a home. You need to account for a down payment considering the type of home loan that you're going to use. You need to account for appraisal fees, the cost to inspect the property, earnest money, any type of change that you want to make to the home. When you are viewing a home, what we learned is go home, folks. A lot of homes are sold as is. So if you walk in and it's your dream home, but they've got ugly carpet and you want wood floors, then you might want to go ahead and have it saved so that when you move into your home, you can cover those expenses to make it move-in ready. So when we were finally in our home and paid for everything, and I sat down and I checked balances, our savings was severely depleted. So now I was like, wow, if we face any type of emergencies in the home now, are we going to have enough to cover it? So your emergency fund should not only cover the home buying process, but once you close on the home, you need to be ready for any type of emergency, because now that home is yours and all the problems that come along with it. If a pipe bursts, you've got to pay it. If you have to call on home insurance, you've got to be able to cover the deductible. Even if your home is still under warranty, you've got to be able to pay the, I think it's the service fee. You're going to have to pay that, and you want to pay it in cash. You don't want to jump back into having to utilize credit now that you're in your home. You want to have a very healthy and fully funded emergency fund. Another question that you want answered is, do you have stable employment? This might seem like a no-brainer, but that's not the case. Sometimes if a company is questioning furloughs, this is not the time to go and get into the home market. You want to wait until you know for sure that the job you are working is yours. You don't have to worry about it. Now, when you're going through the home loan process, they are going to verify your employment, and they're going to verify that you have been employed at your current position for at least 2 to 3 years. That's considered stable, and that there is no risk to that employment. But if your job is flexible, if you are looking into a move, then you might want to hold off on purchasing a home right now until you are in a stable position and can settle down in that area. Which brings us to the next question of, are you ready to settle down? I know for a lot of my young people, you might not know if your current location is where you want to call your forever home. So if you don't know if this is where you see yourself in the next 2 to 3, maybe even 4 or 5 years, then probably a large investment of buying a home isn't the best thing for you to do right now. But if you know for a fact this is it for you, you're not going anywhere, your job is here, your family is here, your life is here, then you might be ready to make that investment and settle down in that location by buying a home. But if you are still open to flexibility, you want to be able to close out on a lease in a year and move somewhere else, look into other areas, just still wondering, what life has to offer, don't feel bad about that. Go enjoy life, live it to the fullest. But you don't have to buy a home in the process. So if you're not ready to settle down, then you might not be ready to buy a home. But if you are ready to settle down, then you might be in the market for a home purchase. Are you ready and willing to sacrifice your time, your effort, and your money to maintain your home? After you buy the home, after closing is done, that's not it. You have to maintain and repair your home. It's yours. There is no more calling a landlord, the property manager, or the maintenance team. You are the property owner and you are the maintenance team, okay? Lowe's is about to be your home away from home, and those agents in there, the service people in there, are about to be your best friend, because everything that comes along with the property is now yours. If there's a leak, if there's a burst, if the HVAC goes out, if there's a roofing issue, if you want to paint, it is all now on you. So you need to ensure that you are willing to take the time and the effort to learn how to do it. If you want to take the time and effort to actually make the repairs and maintenance yourself, or do you have the cash reserves? Is it included in your emergency fund to call on repairmen to come in and take care of these issues when they arise? Because they will arise. Guys, that was quick and to the point. That's the checklist to determine whether you are ready to buy a home. If you are not, if you know that you need to get out of debt and that's going to hinder you buying a home because of the approval process, then go ahead and start tackling that now. Go ahead and start working on your budget to be able to get out of debt so you don't have to worry about your credit score or your debt to income ratio being an issue. If you don't know whether you're ready to settle down, then don't be pressured into buying a home. Look, don't let somebody else's dream become your nightmare. Don't let somebody else's dream become your nightmare. If you buy a home before you're ready because somebody else is pressuring you to do it, then it could very easily become a nightmare experience for you. And last time I checked, don't nobody else pay your bills, wake up and live your life, okay? So do what's best for you. I hope that you guys enjoyed this video. In the next one, we will discuss the different types of home loan options, and then we will go through a step-by-step guide of the home buying process. If those topics are of interest to you, then please subscribe and turn on your notifications so that you will be notified when those videos are published. Until the next time.